It's September the 1st. Welcome to Business Incorporated. I'm Chimeze Obi Iwago. On the show today, Kenya's dollar bonds fall. Stock market holds trading briefly after the country's Supreme Court identified irregularities in last month's presidential election. And Kenya's annual inflation rises to 8.04% in August from 7.47% in July. Plus, Fairfax Africa takes 42% stake in Bob Diamond's Africa Bank, Atlas Mara Limited. Let's get started, and we're beginning with the markets. And both the Nigerian stock market and the Egyptian stock exchange are all on holidays today for the Eid al-Fitr celebration. However, in Kenya, the stock exchange halted trading briefly midway through Friday's session after blue chip shares plummeted following the Supreme Court's decision to annul the August 8 presidential election. Kenya dollar bonds also fell on Friday after the country's Supreme Court's announcement. The $2 billion sovereign bond maturing 2024 fell 1.25 cents to 103.5 cents, its lowest since mid-August. The 2019 issue fell 0.75 cents to 102.75 cents. The Kenyan shilling also came under selling pressure, falling 0.3% against the dollar. Now, the Supreme Court said the Electoral Board had committed irregularities and illegalities during the vote, harming the integrity of the election that handed President Uhuru Kenyatta a second five-year term. And for an immediate reaction on this, I'm being joined by the head of banking research at Ecobank Capital, George Bodo. Good afternoon, George. Thank you very much for joining us all the way from Kenya. Now, George, you are in the banking sector. What is happening to the interbank rates? Are they also reacting to the annulment of the election?
Thank you. Well, the interbank rate hasn't reacted much, both in the overnight liquidity market and the overnight FX market. Not much reaction so far. The only reaction is that we've seen so far in the stock market, where basically at some point the stock exchange had to halt trading for about 30 minutes when the market had lost in excess of $50 million. And basically all stocks were down 10%, so they had to halt. I think they resumed trading, but still when the resumption of trading, the market is still trending downward. But the trending downward of the stock market is basically a reaction to the position of the Supreme Court, which is slightly unexpected, even nicer for unexpected position. So those unexpected reactions point to the fact that the market, largely the local domestic investors, had not foreseen an annulment of the presidential results.
All right. Looking at the banking sector where you belong, are there panic withdrawals there, perhaps in anticipation of any violent withdrawal?
No, we haven't seen any. There's not been any report of bank runs or some crimes. No, we haven't seen that. And largely, the reaction to the decision has been largely peaceful. On the ruling party's strongholds, it's been largely muted. There's been a lot of celebrations on the opposition strongholds. So an expectation of violence, there's really no an expectation of violence across board. I think the reaction has been generally well received, especially among the opposition supporters. And there's been a muted reaction on the ruling side stronghold. So I don't think that this is going to get to that extreme where we have a run from banks. No, nothing like that.
All right. Thank you very much for your time. George Bodo, head of banking research at Ecobank Capital there in Nairobi. Looking at the Middle East markets, of course, all the markets there are on holiday for the Muslim celebration. However, corporate news boosted a couple of stocks in the United Arab Emirates on Wednesday. We can see the numbers there. Abu Dhabi and Dubai up, looking positive as at Wednesday and Thursday. Qatar Stock Exchange and Saudi was, of course, they were down. To Europe now, markets were slightly higher on Friday morning as investors geared up for more data releases while taking note of the positive trading seen overseas. Let's bring in my colleague in Frankfurt, Janelle Dumalon, for more on the markets. Hello, Janelle. Thank you very much for joining us. The U.S. labor report is hitting the wires right now. How much of the figures do we know and the facts behind those figures?
Well, consensus estimates say that we will see 179,000 jobs or more added in August, and that points to a robust jobs market at a time where GDP growth is also robust and pricing pressures remain benign. Now, this also seems to say that the central bank has already achieved its target of maximum employment. We're seeing an unemployment rate of 4.3%. And as such, given that the central bank has already received this target, another thing that would be in focus is wage growth. So with an unemployment rate of 4.3%, strong wage growth at 2.5%, that suggests a bit of weakness there at a time where inflation has also been declining in the U.S. So a lot of these will be taken into consideration as investors try to mull whether we can expect another rate hike from the central bank in December.
Okay, the ECB policy meeting holds in few days' time. What's the outlook?
Well, you know, the Eurozone has actually benefited from a raft of positive data this week. We saw good inflation data, we saw good jobs data, GDP as well. Even Moody's rating agency lifted the outlook for the Eurozone in its ratings call last Monday. So the case for sustaining loose monetary policy indefinitely after the end of the year seems to be fading. So Draghi is still expected to hold still in next week's policy meeting. He's probably not going to say anything, but he might try to prepare the market for some tightening in the autumn. That's at least what investors expect. But the things that he's going to have to take into consideration are, for example, the fact that the euro seems to be gathering in momentum, and in particular, they're worried that the strong euro might hurt exporters and keep inflation down. Remember that a strong currency tends to reduce import prices, and part of the reason why we had this loose monetary policy in the first place was to make sure that we headed off the risk of deflation. So plenty for Draghi to consider there. It's going to be a tight line for him to walk in the next months.
And Janelle, it's a day for PMI's release. The UK manufacturing report is in with a decent 4-month jump reading to 56.9. Now, what does this key economic indicator such as this mean for the Brexit preparations for Britain?
Well, this is certainly good news for Britain. Now, it's higher than the expected forecast. The expected forecast put it at around 55, and manufacturing accounts, of course, for about 10% of the UK economy. So this means that despite Brexit uncertainty, the manufacturing sector is robust in Britain, and of course that can have positive knockoff effects in terms of domestic consumption and the overall economy. So that bodes well for job creation, for example. But Brexit is still going to be a major factor here, especially since the end of the week have seen the talks come to nothing. And it doesn't look like the talks to determine the future of the trading relationship between the EU and the UK will be able to move on in October as originally envisioned. So as such, Britain can take comfort in those very strong numbers for now, but it still has major political challenges to tackle, and these political challenges can shape its economy in the years to come.
All right, thank you very much, Janelle. Is the last business day for the week. Enjoy the weekend.